Michael Oliver is a long-time market analyst known for studying how assets behave when financial systems come under stress, rather than making short-term price predictions. In a recent market discussion, Michael Oliver laid out a view on silver that's very different from the way most people are thinking about it right now. His central argument is that silver's behavior no longer makes sense if you keep looking at it as a normal commodity moving inside a healthy financial system. In his view, the issue isn't whether silver is cheap or expensive in dollar terms. The issue is that the broader system silver trades inside is starting to fracture, and when that happens, price stops being the main signal. What he's pointing to starts outside the silver market altogether. He focuses on stress building in areas like bonds, credit, and highly leveraged financial assets. When those markets begin to lose stability, capital doesn't just evaporate, it looks for somewhere else to go. Historically, when confidence in paper promises weakens, money migrates toward assets that don't rely on counterparties to exist. In that environment, silver stops acting like an ordinary input with predictable supply and demand curves. It starts behaving like a pressure valve, not because people suddenly love silver, but because the system needs something real to absorb stress it can't hold anymore. One of the key distinctions he makes is between paper exposure and physical reality. Futures contracts, ETFs, and derivatives can expand almost infinitely as long as confidence remains intact. Physical metal cannot. When stress rises elsewhere, the gap between those two worlds matters. He argues that this gap is where distortions appear first, long before they show up in headline prices. He also emphasizes that silver's dual role makes it uniquely sensitive in these moments. It isn't just a financial asset, it's deeply embedded in industrial demand, energy systems, electronics infrastructure. That means when financial pressure pushes capital toward hard assets, silver doesn't have the flexibility that purely monetary assets do. Supply can't respond quickly, and that creates tension that price charts often fail to capture early on. Another part of his argument focuses on relative movement rather than absolute price. Instead of asking how many dollars silver is worth, he looks at how silver behaves against other assets, particularly gold. When silver begins to outperform gold decisively, he sees that not as speculation but as a signal that stress is accelerating rather than easing. In past cycles, that relative shift has appeared late in the process, not at the beginning. Importantly, he's not framing this as a smooth or orderly transition. He repeatedly stresses that markets under strain don't move in straight lines. They lurch, they overshoot, they correct violently. Silver, in his view, is especially prone to this kind of behavior because it sits at the intersection of financial psychology and physical constraint. What he's ultimately arguing is not that silver must go to a specific number, but that the conditions shaping its behavior are changing. When leverage unwinds in other parts of the system, silver becomes a mirror reflecting that instability. Price becomes less about valuation and more about stress transfer. You don't have to accept every implication of his view to see why it's relevant. If the financial system remains stable, silver continues trading like a commodity with volatility. But if confidence continues to erode in paper markets, the assumptions that normally keep silver contained stop holding. That's the heart of what he's saying. Not that silver is guaranteed to surge tomorrow, but that the environment it's entering is fundamentally different from the one most investors are used to. And in those environments, markets tend to behave in ways that surprise people who are still relying on old frameworks.